Thanks for joining us today on Market Call. I'm Morella Fernandez. Dan Rohinton with us on the show. He's portfolio manager at IA Global Asset Management. He'll take your questions on Canadian and global large caps. Here's how to reach us today. You can call us toll free at 1-855-326-6266. You can also email your questions to marketcall@bnnbloomberg.ca. Dan, thanks for coming in.
Thanks for having me.
Let's talk about themes you are seeing emerge after the latest round of earnings report. There are still a few to go, but what's emerging to you?
I think there's two things that really stick out. The first one is the general resilience of the U.S. economy as a whole, because it was a pretty good earnings season when you put it all together. That should be bifurcated with AI-related companies seeing the most outsized growth and the outsized demand pull. And then the more negative end of the conversation is that the low mid-end consumer is seeing some struggle. So you're seeing this bifurcation where earnings across the board are fine because of the way the index is composed, where the big companies play an outsized role. And then when you see and peel a few onion layers deeper, frankly, you see that the low mid-end consumer is having a bit of a tougher time because restaurants are seeing some pressure on traffic, some down trading, things like that. So it is somewhat of a two-stage economy, but a lot more positive and some yellow signals here and there.
Do you feel or do you think that that separation, that gap will continue to widen?
I do. And I think it's the nature of if you really take a step back and Canada, and we look globally, but we like to have a local perspective. I think it's important to look at the U.S. market in this case. The U.S. market, as some of our viewers might be surprised to know, is actually almost half technology at this point. So when it comes to the gap, that gap has been going on for 20 years, but I don't see a convergence in the future. I see it more likely than not. We'll see a further expansion in the haves and have-not.
Interesting. Okay. I do want to ask you about energy as well, because there's so many AI energy deals that we get announced almost daily. And you're seeing OPEC happening with a meeting today, and they're talking about whether, how much oil will be needed for the rollout. The deals we see, though, aren't for oil, right? They're for everything else. But do you think there's so much energy demand that eventually that AI demand will have to reach into the oil sector as well?
So, I'll take it a step further and I'll say the conversations on coal are picking up.
Wow.
Believe it or not.
Okay.
So, but there's a longer term story here. So in the short, medium term, when there are bottlenecks, I do expect prices to be basically seeing upward pressure. But OPEC has been, frankly, running a low oil price policy for a while now, where they've been basically adding more supply to the market as that demand has continued to grow. That being said, that's a short, medium-term conversation. Look out 10 years. It's very clear that the role of oil in the mass utilization era that we saw in the last 100 years is moving to more renewables. And I don't mean call it evangelizing the green conversation. It's from a brass tacks perspective, solar deployments are going to rise exponentially, and battery deployments are going to rise exponentially as well. So the role of oil in the future economy 20 years from now will be significantly different than it is today.
But there is a role for one.
There always will be. And that's why when there are periods of shortages, people are willing to, I say jokingly, don't be surprised if Microsoft burns whale oil to keep the data centers on. So the fact that the coal conversations are picking up shows you the acute bottleneck today, but bottlenecks only last for so long. So 5-10 years out, oil will have a far less important of a role to play, but it will always be here.
Interesting. Okay, we're going to take a quick break. We'll line up some phone calls for Dan Rohinton, IA Global Asset Management. He's tackling your questions today on Canadian and global large caps. Here's how to reach us. Back in a moment. Welcome back to Market Call. Let's start with an email from James. He says, I wanted to add WCN to my portfolio for many years, but it's always looking expensive to me. Lately, it's been down. Would now be a good time to add a position for a 5 or 10-year hold? We bring in Dan on that question. What do you think?
I think so. So Waste Connections, let's take a step back into the waste management industry as a whole. So it's basically a oligopolistic structure with a lot of small, mid-sized companies that the big companies are slowly gobbling up over time at attractive valuations. So that's that long-term runway, on top of the fact that, if we're being honest with ourselves, the amount of garbage, or what's more properly named solid waste volumes, have continued to grow at a pretty consistent pace. So you have stable to growing demand, industry structure that's attractive, and pricing that basically outpaces inflation. which gives you a little bit of margin leverage here and there. So there's a reason why it's more expensive than other companies you see in the industrials world, because it is deserving of that type of premium. The reason why the stock is a tactical buying opportunity today is that we're actually seeing a little bit of pressure on recycling volumes, and that's hurting their margins a little bit. And specifically for Waste Connections, there's a landfill called Chiquita Canyon, where they've had to basically take some charges and some remediation actions. The longer story to this, and we can go on all day,
And
but I don't want to
where is
waste
that?
time.
Where is that?
That's in California, actually.
Okay.
So, long story short, it's a buy. I think it's an attractive entry point, but know that it will always be an expensive stock, and that's okay.
Okay, good to know. If you're holding for 5 or 10 years, then a good time to get a position. Let's go to the phone lines. Michael's on the line. He's in Vancouver today. Hi, Michael.
Hi there. My question today is on Toyota. I think it's a great company. I've actually met Jimmy Patterson, but they weren't so worried about acquisitions. They just stayed small within the confines of the country. Is it a good stock, though? Thank you.
Okay, so thank you for the question. Toyota, I'm glad we're talking about some of the car companies because we talked about tariffs and the damaging effects of tariffs on a lot of the North American supply. A company like Toyota coming out of Japan, what situation are they in with the tariffs? Are they as affected? We know Japan's facing tariffs as well from the U.S.
So that type of ambiguity is going to be there for the foreseeable future. So the calming down of the tariff conversation does not mean that it's going to go away. And the whole premise behind the tariffs is going to bring more assembly infrastructure into the United States at the expense of Japan, at the expense of Ontario, things like that.
Yes.
Yeah. So that's the grand strategy. Toyota as a stock today, I think it's a decent industrial company. So if you want to own it over 5-10 years, I don't blame you. If you want Toyota at a discount, Subaru is actually a far cheaper company in Japan, and it actually taps into Toyota's supply chain. So it's Toyota, it owns 10% of Subaru, and they give them all the back end auto parts in the first place.
Interesting. Okay.
So if you want, Toyota, I don't mind the company. Do I think automakers as a whole are attractive businesses to own? No, I don't think they are. But Toyota is decent and arguably the best of the bunch. But if you want Toyota for half the price, go to Subaru.
Got it. Okay, good to know. Let's go on to Elliot, who is in Hamilton today. Hi, Elliot.
Good afternoon. Please, as a follow-up to your waste action, Waste Management south of the border has also reported softening of renewable and health services pricing. Is the 20% reduction an overshoot to the downside? And which would you prefer, Waste Connection or Waste Management? Thank you.
Okay, thank you for the question. Waste Management out of Houston, Texas, same sort of recycling resource recovery. Can you do a comparison?
Yeah, and I'll say tie goes to Waste Connections, and the reason why they're in more rural markets. So Waste Management's in a bit of a deeper, they're in more of the cities, and cities tend to be more competitive because they have more throughput and more density. Secondly, as the gentleman mentioned, Stericycle is the asset that they did buy, and the hope was that they could basically take that type of hazardous waste, medical waste business and make it better. That's fine, but I'd rather stick with garbage. So Waste Connections for me. Because garbage is more consistent and the market structure is more stable than trying to create the solid waste market structure in a very different type of asset class. So when we have to choose for roughly the same valuation, I'd rather stick to the known quantity that is Waste Connections. Okay. But both are great companies.
All right, let's go back to the phone lines. Sylvan's on the line. He's in Montreal today. Hi, what's your question?
Good afternoon. I would like your outlook for TELUS, please. Thank you very much indeed.
Okay, thank you for the question. TELUS is, one of the main telecommunications companies. All the telecommunication companies are trying to find other ways to bring in some revenue, given what has been challenging times for them. But it has a good dividend. So it's at 2031 today. What's your take on TELUS? It's
the most stable of the telcos in the Canadian market. And I think I'll just maybe expand out to what the telco market in Canada and how it's phase shifted from the last 2 years. So as immigration growth has slowed down in the Canadian economy, net subscriber growth, which is a very critical driver for all of the telcos, has come in quite a bit. So the era, if you're looking back to what the stock used to trade at, the valuation, the prices, that was a world ago, and I would not expect that to come back. TELUS is the best position in terms of what their ability to grow is inside core telecom, and there's a few side projects which I would say I would wish TELUS wouldn't do in terms
sort of the U.S. stuff where they're selling off some of the towers
business, So the experiments that telcos do, I'm generally not a fan of. TELUS is the best position, and they have a free cash flow inflection coming as basically some of the fiber building and building out that they have done is going to slow down. So if you need it for the yield, it's okay. Do I think it's an attractive 10-year hold? I don't. So push comes to shove, I'm not interested.
And you're basically saying you don't think they'll recover to what they used to be.
Exactly.
Got it. Okay. Let's take a quick break. Dan Rohinton of IA Global Asset Management here with us today. He's taking your questions on Canadian and global large caps. Back in a moment. Welcome back to Market Call. Let's go back to the phone lines. Chris on the line. He's in Delta, BC. Hi, Chris.
Oh, good morning, Morella. Good morning, Dan. Dan, I have about 6 different stocks and strategies questions that I'd like to ask you. I wish that you would do some sort of podcast or teach at a local college because you have so much knowledge.
Thank you.
Absolutely. The first thing I'd like to, I'm calling on Apollo, which I bought last time on your recommendation, your thesis. And I'm wondering your current thoughts on that. And if I can also just, in general, on an educational note, what are your thoughts on leverage? I've been using leverage for about 5 years now, primarily, with Canadian dividend paying, the tax credit, the write-off, the interest, et cetera. And it's worked out well. The rates aren't exactly, the spread isn't exactly as wide as it used to be, but there are still lots of opportunities, and I'm curious your thoughts on that strategy. Thank you so much.
Thank you for the question. So Apollo's an asset management company. They're at 124.03. They've gone a little bit down this year. Is this a stock that you held at one time? Do you still hold it?
Yeah, we hold it. We've been buying more. And the reason, just to give a breakdown on the Apollo thesis and why we think it's interesting, is of all the alternative asset managers, they're the best positioned because they have the most differentiated channels to actually grow. So whether it's retail, whether it's institutional, whether it's the insurance side, this is the platform that catches it all with a management team that really knows its stuff. That being said, what has been going on more recently for Apollo, and I think it's overblown for Apollo, but it has been rocking the industry a little bit. There has been a few defaults in the bond market.
Yes.
And those have gotten a lot of fanfare. I think sometimes it's easy to miss the forest from the trees. Those are normal in credit environments, but every time there's any issue, investors think that there's a systemic problem and we're spiraling into 2008, 2009 all over again.
Shy, right?
Exactly.
Yes.
So where the cockroach theory, as Jamie Dimon has coined it, I think that's overblown. I think Apollo is well managed, and I would be buying into the stock today as part of a diversified portfolio. A second point on leverage is I think it's important across the board when we're talking about leverage to be careful. It's very easy in a market that's only gone up for the last decade, but say for a few major corrections here and there like COVID and the tech issues of 2022, to think that if you just double your equity holding with some of the bank's borrowed money on margin, then you're twice as smart. I would be very cautious and say equity investing should be generally unleveraged, even if the interest write-off is there. I understand that there's tax strategies that are available as a part of that, but for a good peace of mind and a good night's sleep, stay away from leverage when it comes to investing in equity markets, because you want to be able to see the drawdown through. The most important thing about 2019 to 2022 was being able to stay invested through that market. And margin and leverage does not allow you that type of optionality.
Okay. Chris, I hope that helps you. Let's go on to Nazar, who's calling from Scarborough today. Hi, Nazar.
Oh, hi, Marilla. Hi, Dan. May I have your thoughts on Manulife Financial, please? This stock has been range-bound between $43 and $46. Are you positive on the stock and life goes in general? And if I may, do you prefer banks at this time with the declining interest rates? Thanks for taking my call.
Okay, thank you for the question. Let's start with Manulife at 45.90. Where are you on sort of the insurance space?
So I'll take a step back. If you're taking a global lens to it, do I think you need to be invested in life insurance companies across the board? I don't think so. Within the Canadian context, life insurance has a very prominent role to play. I think Manulife is attractive. I think their capital structure is in the right place. I think it's far more de-risked of a company than it was 10 years ago, 10, 15 years ago. So do I think it's the best positioned large cap life co today for good, strong equity markets? I do. So I would be a buyer today of the stock. Then taking a step back on the conversation around banks versus life insurance, I don't think that it needs to be that type of choice. You don't need to own TD Bank or Manulife Bank. You could own something anywhere around the world that is far more attractive than what TD offers today or the rest of the Canadian banks. And maybe I'll take this point to expand on the banks a little bit. I do think the banks are more fully pricing in a very benign Canadian economic outcome. They're releasing reserves. They're trading at 20-year highs on multiples, depending on the stock. And that's an interesting place to be when home prices across the GTA and many other metro areas in Canada are seeing declining home prices. So I'd be very cautious on the banks as a whole. But if I had to choose between life cos and banks, life cos every day of the week.
Okay. Let's get back to the phone lines. And Kevin's on the line. He's in Aurelia, Ontario. Hi, Kevin. How are you doing?
Hi. Thank you for taking my call. My question's on Canadian natural resources. It's been stuck in a very tight trading range over the last year, and that's because oil has been hovering around $62 and change. I'm just wondering, would you be a buyer at this price today? My concern is long-term, though. Will oil be used less as the years go on with the adoption of electrical vehicles and that? And I'm just thinking there'll be less demand, less price for oil. Thank you.
Thank you for the question. So this sort of
Yep.
on our earlier discussion about whether oil will be used for the build of AI, would you buy oil right now? They've been trading sideways for quite some time, and there's no indication that the price of oil is going to get back up there.
Yeah, and once again, I'll maybe just give that first principles point again of just because energy demand is going to grow, oil will have a role to play. Will it be as important to the global economy in the future? No, but that's just because oil demand might stay at 90 million to 95 million barrels a day or creep over to 100 million over time, and solar is going to go up exponentially 10, 15-fold from here. So oil's not going away. So don't worry about the doomsday scenario of we're all going to be taking the Jetsons or anything like that. We'll be having industrial uses for oil, and if North America doesn't and Europe doesn't, India will and Africa will. So commodities have this wonderful way or bad way, depending on your view and direction, of balancing itself out on the global demand pool. That's the umbrella conversation on energy. Energy prices are frustratingly being reflected in C&Q's stubbornly low price. But the important thing with C&Q is it's the lowest cost producer, it's well managed, they're consolidating the basin, and they don't have debt, which means that they can pay back all their cash flow back to shareholders. So think of this as a stock where it doesn't need to go up too much from here for you to collect a large and healthy variable dividend depending on the prevailing stock price. And I think that's the real story here. So in terms of energy in our portfolios, we don't own tons of energy as a whole, but we own tons of C&Q within the energy portions of our portfolio.
All right, good to know. I hope that's good for Kevin. Let's take a quick break. When we come back, a look at past picks from Dan. Back in a moment. Welcome back. Time to go through some past picks with Dan. September 30th, 2024 are when these picks are from. At the time, Dan chose LVMH, Louis Vuitton, MC. So 688.50 at the time. This is euros. It is just at 615.90 right now. So 11% downside, 9% total return downside. What is happening with the luxury company here?
So the luxury company, this is the big Louis Vuitton, Dior, all the major brands, including Tiffany's, all rolled up into one big conglomerate. And the issue that they've seen is they've actually seen a slowdown in the Chinese consumer, because believe it or not, the Chinese consumer is a lot more focused on buying gold right now. So they've been going through a cycle there. So that has been a little bit unfortunate. We have been buying the stock throughout this whole period of time. It's still in the portfolios, and I still think it's interesting as a long-term hold. But for what it's worth, the luxury market is going through a bit of turbulence because alternative sources of showing off your wealth, like buying precious metals, has been taking market share.
Interesting.
Yeah.
Okay. Let's get to your next past pick then. Visa on the New York Stock Exchange. Visa was going sideways for a little while. Let's take a look at where it is today. So September of last year, it was at 274.95 US. Right now, it's at 338.65. So 23% upside, a 24% total return. Do you like the credit space at this point? Are there competitors that you worry about in Visa?
Yeah, and I think what you're alluding to is stable coins,
Sure,
digital finance, cryptocurrencies, and what have you. And the question is, how is the structure of the market going to be? So there's a lot of pockets of payments that I think are very difficult to invest in today. Merchant acquiring, think of your Fiservs of the world that are seeing a very rough period of time. Visa is that credential network. So the risk for cryptocurrencies is that they build a parallel system. And there's some elements of risk to that, but then we have to look at what the positives are as well. Agentic commerce, as the dream of AI in its fully transformed, metastasized form, will be agents transacting on their own. There's no better credential network than Visa to make that type of happen, make that type of reality come to pass. So there are risks to the Visa conversation and MasterCard in lieu with that, at the same time as there are opportunities. What's interesting about the stock more recently is that it should actually be up more than it is today. And I think it's just, we're long-term investors, so all of my past picks are also my future picks. So they're also in the portfolio right now. Visa is actually being left behind because so much money is going into the AI trade. But I think Visa is a tag-along beneficiary, and I think it's one of the most durable companies in the S&P 500.
Do you expect to see, as we've started to see now, then some agreements between like ChatGPT and a Visa and we've started to see some of those financial products online, so you can pay for things if you want to pay for it through your AI chatbot as opposed to going to a website?
If I was Visa's development team, that would be my single greatest priority today, is to make sure I'm embedded in an agentic commerce through Google Gemini and ChatGPT. No, 1,000%. And they have every right to do so, because the beauty about what they offer is that they give you connections all around the world with high confidence and high trust with a brand that everyone knows. ChatGPT doesn't want to rebuild that on their own. They don't want to use things like Tether or Ether or anything like that to recreate that when the major brand is already making strides to partner with them. So I think that type of hand-in-glove initiative is absolutely what they should be working on, and they probably are.
Okay. Let's get to your third pick from September of last year. Then, is it Transdigm?
TransDigm.
Thank you, Transdigm. Transdigm Group, TDG on the New York Stock Exchange, 142.13. Recommended at now to 1298.27. So downside of 9%, but a 3% total return. And they do aerospace manufacturing, and they're out of Cleveland. Tell me a little bit more about their business.
So this is the company that makes the seatbelts on the plane. It makes the life jackets. It makes parts for the bathroom and parts for the engines and the avionics. The reason that the stock price is more volatile than the actual return for investors has been that they do large special dividends. So when you do a large special dividend, like $100, that comes out of the stock price, but it gets paid out. Okay. Which is why the price is lower than the actual return investors would have gotten if they had held it. But the beauty about this company is that this industry, like Waste Connections as an example, is very fragmented. So you can buy your competitors, and then you're basically sole sourced into the plane. So if you're building those seatbelts, the FAA is not going to allow Boeing to change up the type of seatbelts. So once you're spec'd into a Boeing 737 or a 777X or any type,
that's it.
For the next 50 years, the only type of life vest will be that one. Seatbelt, so on and so forth. So that stability of cash flow and durability, they're just building up more of that by buying up more of their competitors. So it's a roll-up strategy, it's a capital allocation strategy, and it's a special dividend company on an industry that is growing on a secular basis. This and GE Aerospace are the two in my mind.
Okay, good to know. Transdigm Group, TDG on the New York Stock Exchange. We're going to take a quick break. Back with Dan Rohinton of IA Global Asset Management in just a moment. Stay tuned. Welcome back, and thanks for joining us. We'll start with an email right now from John. Would like Dan's opinion on LB. Is it profitable and trades at a low PM ratio of 10.5? Is it ripe for a takeover by one of the other large Canadian banks or by a foreign one? We do get a lot of questions lately about M&A. There seems to be more movement in the back end of the year, and some people are wondering. What do you think?
Yeah, so Laurentian Bank trades at 10.5 times earnings, which is a significant discount to all the other major Canadian banks. And I think the big question to really ask on a company like Laurentian is, they could be taken out, but they were already for sale, and nobody bought them.
Okay.
So when you say put up a big for sale sign, and no one comes to your door, and HSBC was bought by Royal Bank, Canadian Western Bank.
Why do you think that was?
Depends on the quality of the assets and how competitive it would be to actually expand in the Quebec market.
Okay.
That's my hunch. And then it goes back to what is the strategic value of it. So when you do a big bank merger, or sorry, a little bank merger with a big bank in this case, more likely than not, the synergies you get and the way you pay for the premium you're getting is you're going to have to fire a lot of people. And I think that's going to create a lot of political turmoil, and it's not really worth the synergies if you have to lay off half the branch staff. So that's why Laurentian Bank is stuck in this limbo, because if we take a different type of transaction like National Bank and Canadian Western, there aren't a lot of cost synergies there. There's a huge premium to Canadian Western shareholders, but National is happy to pay it because they get to expand further out of Quebec and grow in Alberta and central Canada. So that made tons of sense to do. HSBC was commercial banking, so it's not a lot of branches, and it's a lot more mid-back office stuff and a big loan book. Nice, easy fit. This is retail banking in Quebec, and if you say you're going to lay off half the staff on an acquisition, I bet you that is going to create some big issues.
Political pushback alone, yes.
Political pressure is probably why this company will never be sold in this type of format.
Okay. All right, I hope that answers a question. Let's go to Amin in Ottawa with a question. Hi, Amin.
Hi, good afternoon. My question for the guest is gold in a bubble, and is it prudent to buy gold mines in comparison with gold bullion? Thank you and have a nice day.
Okay, thank you for the question. We did look up spot gold a moment ago. It was at 4,011 at this point. If you're in the gold space, what should you look for? A lot of people talk about mining and it being hard to be in mining. There's so much sort of that effects going into that. But if you're looking to get into gold, what would your choice be?
I mean, let's take a step back and just say there's different ways to participate in the gold run. In the gold run, you can own the metal, you can own the mines. The mines. What's interesting when you go through a really, really aggressive gold bull market like we've seen, is the metal tends to do just as well as the miners, even though the miners have more operating leverage. The reason for that is that the mining companies, the investors who own those, don't fully price in all of the spot gold upside. That's a lot of technical jargon to say. As you go start doing what's known as blowing off the top, the metal does just as good as the companies that should have the operating leverage. So it might just be simpler to own the metal. Then let's just break it down and say, well, what types of, what's the reason why gold has been so strong? There's so many different theories, and gold is uniquely this type of precious metal where supply can turn into demand because the people who own the gold can sell it, and the people who are buying it, and vice versa. So that back and forth creates this awkward dynamic where speculative runs can really run hot. I think this has been one of the best gold markets we have seen in a very, very long time. And I'd say if you're worried about the structural reasons of why someone would own gold for 20, 30, 40 years as a part of a core allocation, I'd say just own stocks. Because stock markets with companies that are diversified, that have pricing power, can basically pass on inflation and debasement too. So the reason you own gold for decades is because you think that the fiat money system is going to mean that your real dollars are losing value every single day. A company like a Microsoft can basically pass on inflation and then some, and you get productivity benefit. So gold doesn't have a research and development department, and Microsoft and a lot of quality companies do. So I'd say don't make it a false choice and say miners versus the metal. Stocks, miners, and metal. I'd say the metal and the miners have run quite a bit, and I'm skeptical about where we are today. And I'd much rather own stocks as a long-term debasement story.
Okay, good to know. Let's move to Mark, who's calling from Ottawa today with a question. Hi, Mark.
Oh, hi there. Dan, my question is on UnitedHealth. They reported last week their earnings, and the stock is down 10% since then. Just your thoughts on the earnings and whether you think this is a long-term hold here, or would you move on at this point? Thanks.
UnitedHealth just keeps getting hit. I mean, it really has not come back the way a lot of people had thought it would.
Yep.
Do you think it'll turn around?
Yeah, I'm actually pretty optimistic on it. And what I would say is the recent move in terms of the 360, 370 to the 330s that we see today is largely a function of what's going on with some of their competitors, not UnitedHealth specifically. So bad reports from some of their peers has been why the stocks drifted lower. I would say as a whole, the insurance industry is not as good as it used to be, but that doesn't mean UnitedHealth in the 300s is the right price for it over the next 5 years.
Not as good as it used to be in the U.S. because of what's going on with the administration, or something else?
Twofold. The first one is that the Medicare Advantage business, there's just fewer people to enroll than there used to be. Okay. So the long-term growth algorithm isn't as good as it was before. But what's made UnitedHealth particularly weak stock in the last year has been there's been that double whammy. That costs have really started spiking higher, but they've got that more under control now than they had before. So when you go through insurance underwriting cycles, as many insurance companies do, there is an opportunity to catch it on the way up. And I think, unfortunately, we were there on the way down, but on the way up, I do think that's where we're headed. And as you look forward to next year and the year after, this company should grow its earnings high teens and on a consistent basis for the next 3 years. So I think they're going to get back into the 500s, but I'll admit that it's been a painful ride from here.
Okay. Let's take a quick break. We'll be back with more of your phone calls and your emails for Dan in just a moment. Stay tuned. Welcome back. Thanks for joining us. Let's go to another caller. Lawrence is on the line in London, Ontario. Hi, Lawrence.
Good afternoon. Thank you for your past suggestions. What is your opinion on selling my bank stocks and buying Brookfield Wealth?
Okay, thank you for the question. We'll pull up Brookfield Wealth and have a look at that line chart in just a moment. Do you like the Brookfields generally?
Yeah, I think the Brookfields are an interesting conversation, to say the least. So in terms of the banks in transitioning to Brookfield Asset Management, which I believe the company we're talking about here, the first thing is the tax consequences, and it might be a bit of a tomato because both are risk on, beta, but I do think in general we are inclined to be in that direction. So I do think Brookfield Asset Management is a more attractive opportunity than the banks today. And Brookfield Asset Management as a whole is basically just the Brookfield pieces, but with a more defined fee stream and a more defined dividend yield, versus Brookfield Corp is a little bit of a different piece where they get some of the carried interest. So call it more financial engineering, slicing up the different layers of Brookfield. I do think it's an interesting company. Do I think it's the best alternative asset manager in the world? I don't. I said it before that I think Apollo is a better opportunity if you want to zoom out of just the Canadian market, because Apollo's got more levers and more depth to it and faster growth for a cheaper price. But in the context of a Canadian constrained portfolio, I think Brookfield is attractive.
Okay. Lawrence, I hope that helps you out. Let's go to an email from Richard. Dan's thoughts on CSU, please, which is Constellation Software. Right. Constellation Software has been dragged down by the leader stepping aside, who's been with the company for a long time. I think there's a health problem there.
Yes.
And then what do you think of the way or what they do as a business, which is acquire software and then move on? There are concerns about if that's a viable business moving forward.
Yeah, and let's explore so Constellation Software with Mark Leonard having some health complications. Those are very big shoes to fill. He's a legendary investor, and I think that's understating his stature. But what's driven the stock from the 5,000 range roughly to where we are in the 3,700 range has been the idea that what is the role of a distributed capital cities-like model when it comes to software, where you buy the vertical management software for golf carts or golf courses and building materials and hundreds of these types of tiny things.
Yes.
I think that is at risk as you look forward. So do we own it in the portfolio? We do, but I do think it's increasingly going to be something that we do trim as on periods of strength. And I think we should be careful to invest in software as a whole, and we have to be a lot more focused on that And I don't think you need to start with Constellation Software. I think you can go to a Workday or ServiceNow in the United States.
Salesforce, something like that?
Yeah, Salesforce, but Salesforce has its own dynamics maybe to worry about. So maybe Workday was a better analogy. So I think there's higher quality software than Constellation. I don't think their model is fundamentally broken, but you do have to ask yourself, is it possible to replicate what they've done? I do think so. In a way, I would have never said that 5 years ago.
Okay. Some are saying some of the software is so integrated in the systems, it doesn't matter. That software is not going to go anywhere because it's built into the systems. Does that apply to Constellation Software?
It absolutely does. And it's been the reason why this has been one of the best performing stocks in the Toronto Stock Exchange for the last 2 decades. But there's a but to that. Part of their model is taking up pricing. Part of their model is basically saying, well, you're so locked in that we can charge you whatever you want. I don't mean in an extreme way, but you might be forced to cut your prices 5%, 10%, because there might be competing software that's easily spun up that is taking market share from you. So don't underestimate the loss of pricing power that comes even though you're fully locked in.
Okay. Let's get to another email then. Billy wants to know thoughts on REI, UN, RioCan. Is it a buy or hold at this point? Thank you for the question. RioCan, a REIT, I guess, for shopping. And is this a space you guys put some money into?
We've been fans of RioCan in the past. I think as we look towards these types of REITs, I'd say there's a few companies in the United States where you could probably lean towards a little bit more. So retail REITs, the whole premise, and this is more commercial as well, I would be a little bit skeptical to really step into RioCan. Canadian REITs as a whole have high payout ratios, so they don't have a lot of flexibility financially. So if you want to go get a yield and stay on the right trend as it relates to e-commerce, there's a company called Prologis that I think might fit our friends across the screen's perspective and needs a little bit closer. It's e-commerce, it's distribution centers, it's data center development, and it trades at a reasonable valuation. So you can get RioCan for a cheaper price, but I think it's a different type of value proposition.
So is it Prologic or Logis?
Prologis, PLT.
Okay. And that's out of the U.S., you said?
Yeah. So I think it's a better fit for an income need with less debt and a better, underlying trend picture than Canadian REITs.
Okay. Let's move to another email from Paul, who's in London. He says 3M has been on quite a run in the past 12 months. Still more share price growth. Let's pull up 3M, which I haven't looked at in a long time. What's 3M doing these days?
Yeah, so 3M was quintessentially known as the innovative company where 15, 20% of their products are new innovations, things like that. Then it got wrapped up and mired in basically some PFAS liability discussions, and those are what's known as the forever chemicals, where there's a lot of potential. It's the new asbestos, if I can maybe put it that way.
Yep.
So I would actually take profits on 3M, and I think it's more interesting to buy more in a more structurally sound industrial companies. Like think of maybe a Honeywell that's got an aerospace business. Think of what used to be the different pieces of United Technologies. So do I think do I take profits on 3M today? I would, because I think there's better industrials that you can own over the next 10 years.
And sorry, what led to that run up that we've seen in the past year?
The implied better outcomes as it comes to PFAS.
Got it. Okay.
On top of just getting your house in order a little bit. So more of the clouds are clearing a little bit, but then that also opens up the perspectives to say, well, what do we have after the special situation period for 3M is over? It's a lower growth, multi-industrial that's kind of running to stand still.
Okay, so take some money, trim it at least, and then move back.
Yeah.
Okay. We're going to take a quick break. That is all the time we have for phone calls and emails, but Dan will share his new top picks. That's coming up next. Join us tomorrow on Market Call. We have a new guest, Ernest Wong, Head of Research at Baskin Wealth Management. He'll take your questions on North American large caps. That's tomorrow. And if you missed Market Call, you can check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. All right, let's get new top picks from Dan. We're going to start with Lind, L-I-N, on the NASDAQ. Tell me what you like about Lind. It's a gas company, essentially?
Yeah, so industrial gases, and it's basically the unsung hero when it comes to complex industrial processes. So this is the type of company where basically they build air separation units and they give specialized gases to whether it's steel mills or data centers. So it's a proxy for industrial production and industrial activity. What they've been seeing pressure on more recently has been hydrogen. And so that's why I think there's a tactical opportunity to buy what is a high quality long-term company. So it's an oligopoly structure. This is the best managed company of the three. So there's Linde, Air Products, and Air Liquide. Linde is the best and biggest of the bunch. And I think it's an attractive valuation for what is a mid to high single digit earnings organic grower, irrespective of the economic environment, and a 2% yield on top. So I think you can get a 10% type of return. This has been a stock we've owned for a very long time, but it's something we're adding tactically to today.
Okay, just wondering, because you mentioned it could supply, for example, steel companies. What other companies would benefit from Linde? And, is the AI build out going to look towards a company like this for what they do?
Yeah, and the best way to think about it is you'll see these trucks, whether it's a Praxair truck or a Linde truck. Mm-hmm. So when you're by a steel mill or some type of manufacturing facility, around it about, I believe the number is around 200 miles, you basically have a monopoly on selling what's known as merchant gas to any local company in smaller canisters. So if there's if you're in the medical area mm-hmm. and you need medical oxygen, this is the company that provides that as well. So they don't tell you it comes from a steel mill where the original pure oxygen is done, but that's how it's all structured. So it's call it an anchor facility, and then 200 miles around it is where all of the catchment area sits. So the answer is, where's the demand coming from? It's kind of everything. But then specifically to your point on data centers and AI, one of their biggest projects is actually in Korea with Samsung to build out a big memory fabrication facility. So when you really need it for specialized semiconductors and then some, I don't want to make the case that this is an AI play, because we're going to talk about a few others, but I think this is a high quality industrial run really well at an attractive valuation today that you can hold for the next 10 years.
Okay, let's get to your next pick, which is Amazon. It is Amazon. Mm-hmm. Amazon and it's AMZ, and of course on the NASDAQ. Amazon recently reported its web services did very well. There were eyes on that to see mm-hmm. sort of how well it would do. Do you like Amazon on the future of AWS?
So it's a bit of both. And I wish we had this conversation on Thursday, because we could have helped our friends across the screen make a little bit of money. But I think it's attractive on a medium-term basis. And the reason I believe that's the case is it's not just Amazon Web Services, which proved this quarter that it's losing market share. But when the market's growing so fast, who cares? So AWS is well positioned. It's the largest company. They're adding on tons of power and tons of chips. And the reason the stock is up today is because they announced a deal with OpenAI as well. So this company has every right to play and distribute AI to the masses and do so in a cost-effective way with good margins. That's one point of Amazon. The second point is what you alluded to with e-commerce. It's by far the best distribution of products, goods products around most of North America and growing in other parts of the world. That business is not a sleeper either anymore. The margins on that have significantly expanded. So the Amazon of back in the day, where they wouldn't make any money and you'd question, is it profitable or not? No, this is one of the most profitable retail companies on earth, and you can see it in their numbers today. And they're so profitable that it's hard to invest the dollars to hide that anymore. So the real story of Amazon is it trades cheaper than Walmart, it trades cheaper than Costco, it trades cheaper than Oracle, and it's got the best of all the bunch.
Okay, so Amazon.com. Let's get to your last topic, Taiwan Semiconductor. Taiwan Semiconductor, of course, a very well-known name, competitive in its space, but tell me why you've picked Taiwan over some of the others.
Yeah, and the best way to think about Taiwan Semiconductor is, let's talk about the AI trade in a more high-level sense first. There's different ways to play it. You can go really, really esoteric, go to the data memory guys, you can go to the copper companies, you can go to all of that. You can go more, call it vanilla, is in the Avagos and the NVIDIAs. But the company that enables all of this to happen is Taiwan Semiconductor. So this is a monopoly when it comes to leading edge fabrication of semiconductor chips. So the reason NVIDIA's margins are so high is because they say, here's a design, Taiwan Semi, go do all the hard work for me. They just announced today that they're going to increase prices about 5 to 7% per year for the next several years. And they earn very high returns on their invested capital. And it trades at a really cheap valuation for the growth that we see ahead. So the risk you run by going all the way to the esoteric end of the AI conversation as a portfolio manager is you run the risk that these products get specced out. If you believe that AI is even modestly real, Taiwan Semi will have a role to play for many, many years, and there's no debate about that. That's the beauty of it. So you don't have to take the risks of Intel. You get a cheaper valuation and more durable growth.
What valuation is it at?
17 times earnings.
Okay. And just
It's
for
half the price
viewers,
of NVIDIA.
give the comparison for some of the others, if you don't mind, so that people understand what that 17 means.
Yeah, so it's basically half the valuation of NVIDIA. And there's different reasons behind that, but half is too low. Then the second piece, if you take their direct competitor, Intel, they're basically making a technology bet that they're going to leapfrog. And whether that's true or not, why do you need to take that bet when this company is effectively going to give you all the benefits?
And they're already there.
And they're already there.
Yeah.
So we like Taiwan Semi as our anchor position in technology because it deserves to be.
Okay. We do have to leave it there, Dan. Thanks for coming in. Good to see you.
Thanks for having me.
And thank you for watching Market Call today. We'll see you back here again tomorrow.